Hello, my name's Angus Murray. I'm the CEO of Castlestone Management. I'm going to introduce in this presentation a fund we are opening called Equity High Yield and Premium Income. It uses the same strategy that I've been using for plus or minus the last 2 years in my own single family office. And in principle, the objective of this fund is to provide investors with a fund that is transparent, liquid, easy to understand, only holds market traded instruments and does not use leverage. That, I think, is a qualification that many people want today in terms of an investment. In terms of selecting the stocks, it is quite simple. We are looking at stocks that we class to be semi-monopolistic, inelastic in demand, strong balance sheets, and that have quality fundamentals. The most important aspect behind that is that the stocks are yielding between 4 and 6% per annum. Now, the examples of that we've given here are Sydney Airport, AstraZeneca, and Singapore Telecom. To enhance the return to investors, what we do is go through the process of then doing something that is quite simple, and that is writing a covered call against the underlying securities that we already own or the portfolio already owns. And in doing so, we generate premium income of between 8 and 14%. And I'll discuss that in more detail as we go through this presentation. You can see here on slide 3, and then again I come to another one on slide 5, talking about the type of stocks that we hold inside the portfolio and how they have relatively performed over a period of time. On slide 3, you can see that we have given an idea of how the Societe Generale Global Quality Income Index has performed versus the S&P 500 and the Euro Stoxx 600. The reason for that performance, and I'll go one slide forward, is really that the dividend yield represents the biggest component of the equity returns. And then you can see that this type of portfolio actually uses the same type of stocks that we are interested in looking at. AstraZeneca in this case, Deutsche Telekom as examples. But the index here excludes financials, whereas the fund as we currently manage it does include financials because we believe that most of those are in a healthy state today and therefore they do fit within the profile of the type of companies we are looking at. So you can see that these stocks naturally do outperform their benchmarks. If I go through to slide 5, you can see here we've given a comparison of the S&P 500 Buy Right Index over the S&P 500 and 2 other benchmarks. What is interesting, not surprising, if you go through the process of writing a covered call over an index or over particular stocks, you will get premium income for that, and that allows you to naturally outperform your benchmark. So in effect, what we are trying to achieve is by giving people semi-monopolistic, price inelastic, quality stocks with attractive dividends and adding to that by generating additional premium income, we hopefully are therefore generating returns of somewhere between 14% and say 16% as a target, irrespective of what's happening with regard to equity movements. Now, of course, the portfolio will go down in value as markets go down. It will go up in value as markets go up, and I'll discuss that in the risk section. But it is this income from the dividends and the premium income that is most interesting to investors today. The fund is a daily traded fund. Obviously, given the underlying instruments, the liquidity is not a concern at all. So going on to the type of stocks that we hold in the portfolio, I've given you a list here on slide 7 of the type of companies that we would hold inside this portfolio. You can see the names of the companies here. You can see the sector diversification that we have and the country diversification. What's most interesting with regard to this slide in particular is the average dividend yield that these stocks are already on. And you can see here within the dividend yields, which is a gross number, it is an average of 5.98%. In terms of the premium income that we are able to generate by writing a covered call 60 days out, it is an average of 13.89% in terms of premium income. Some of the stocks have lower premium income because they have lower volatility, and some have higher. In the case here of, say, comparing a Deutsche Telekom with an ANZ Bank. But these are the type of stocks that we hold inside the portfolio. One thing that we've added here on slide 8 and also on slide 9 is just a brief comment on Australia, because the portfolio does hold a number of Australian stocks. It is, of course, a developed market equity fund, and therefore Australia is within that developed market. But Australia has a characteristic which is quite attractive to this particular portfolio, and that is that Australians are forced to save 9.25% of their income, and they get an enormous tax benefit from buying stocks that are fully franked in terms of their dividends. What that ends up doing is allowing us to get the characteristics in certain companies that we like, being semi-monopolistic, price inelastic, and good balance sheets, with attractive dividend yields and also a liquid option market. Obviously, given the fund in itself does have share classes which are in dollars, euro and sterling, we do go through the process of removing or mitigating the Australian dollar risk of the underlying stocks that we hold by hedging the currencies. And you can see here again on slide 9 what we mean by the attractiveness by Australians for Australian stocks in the bottom right hand corner, where a stock with a 5% yield is actually worth to an Australian inside their superannuation pension plan as much as 7.1%. Hence the support Australians have towards buying Australian stocks with these high dividend yields. Going on to the portfolio here on slide 10, we've done a chart here of Sydney Airport and then done a comparison to Sydney Airport including the dividend and the premium income from writing a covered call. And naturally you get an outperformance of the stock with the dividend and premium income than you would over the stock itself. And that outperformance, being 24%, is quite easily explained. Given this chart is nearly an 18-month period, what you're looking at is a just over 5% dividend yield with between 10 and 12% premium income. If you add that up, you quite clearly see why you would get a relative outperformance of around 24%. To explain the process of writing a covered call, we've taken a screen grab here from Bloomberg, which is very easy for us to show people, and we've indicated in, and this screen grab was taken on October 9th, that if Sydney Airport, trading at a share price of $4, had this as an option market, which is basically indicating that an option in November, i.e. 50 days away from the day we printed this screen grab out, had a strike price of $4.10, the premium income that comes into the fund is 5.5 cents. And I will explain that in a little bit more detail to you. But what it means is that every 50 plus days you are able to gain 5.5 cents in premium income. And as a consequence, if you put 5.5 cents over $4, you get 1.375%. Now, it's never going to work out perfectly, we're all human, that occurs every 50 days, but you can see very clearly and easily how you are able to generate that premium income of somewhere between, say, 10 and 14% per annum. So there are 3 steps in the process that we look for with regard to selecting stocks inside this particular fund. The first part is to identify a universe of stocks that are semi-monopolistic, price inelastic, have quality balance sheets, that are listed in developed markets, and where they tend to have an attractive dividend yield. Our objective would be to achieve a dividend yield of between 4 and 6%. The second part of the process is to make sure they have a liquid, exchange-traded option market that allows us to write covered calls. And that's obviously where we are able to go through the process of generating the premium income. And then the third part of that is to make sure that the companies that we're investing in have maintaining their good balance sheets, particularly maintaining their dividend policies, and seeing how we can mitigate risk relative to the movements up and down in equities. But the broad comment we are making is that we don't think equity markets are going to go anywhere point to point over a long period of time, and that investors will benefit enormously from the dividend yield and the premium income, which, if nothing else, offsets the costs of the manager, being us, the financial intermediaries costs, the tax-effective investment platforms that most investors use, but still allow an investor to get an adequate return. In terms of a brief description here on call options and the buy right strategy, we certainly will be able to discuss this with you in person if you're interested, but briefly, a call option is the right to buy, but not the obligation to buy, a stock at a particular price at a particular point in time. Obviously, there are many people out there who want to do that in expectations that stocks are going to rise, and we simply take advantage of selling a call option to those individuals. And that is where the covered call part comes into play, where because we own the stock already, we are able to sell a call against that stock, and that significantly lowers our risk associated with the fact that we already have the stock inside our own portfolio. So the example that we have given, that I showed you on the Bloomberg screen grab, is basically if Sydney Airport was trading at $4, we could sell a option 50 days out with a strike price of $4.10 for around 5.5 cents. What that means is that the fund makes a return, because it makes 5.5 cents of premium income over $4, of 1.375%. That's over a 50-day period, obviously giving you an annualized number of 10.03%. Obviously, in terms of where you make money or where you may slightly underperform, which is one of the risks worth highlighting, is if the stock were to appreciate above $4.15.5, which is $4.10 plus 5.5 cents, then you will underperform. However, if the stock remains under $4.10, then you will outperform by the premium you get in, and if the stock declines, you will outperform by the premium that you get into the fund as well. Under those scenarios, we see over a long period of time this being enormously beneficial, hence the outperformance of the S&P 500 buy right index over the S&P 500. Slide 15 just talks about how that option premium declines in value as you come closer to the expiry date. Just a normal option pricing strategy, very easy to understand, all liquid in terms of the instruments that we hold inside the portfolio. Slide 16, we have added in here an example of the single family portfolio that I have been managing. There's a definition in the SEC called a single family office. It's where it runs money for only for an individual family, and these are the type of stocks and exactly the same strategy that we've been running for a period of time, and we'd be happy to disclose that to investors. But what you can see here is that these higher yielding stocks, which obviously semi-monopolistic, price inelastic, how they have performed versus the benchmark being the S&P 500. Obviously, when expectations came around of interest rates or quantitative easing and interest rates potentially rising, some of those high-yielding stocks underperformed. They have subsequently risen. Obviously, with the ECB going through the process of cutting rates recently, higher-yielding stocks are going to be much more attractive. But the main point that we would highlight here is the relative outperformance of what happens when you add in the dividend and the premium income. And that is the enormous benefit of this simple strategy to investors today. The risks, which is always worth highlighting to people, is about that underperformance. The fund will tend to underperform if equity markets continue to rise in a straight line. Obviously, because you are writing a premium income, then you are effectively pre-selling the stock at a certain price. But given markets rise and fall, and we've clearly seen that over the course of the last decade, most likely to see that over the course over this decade, we think in the end the advantages of the dividend yield and the premium income far outweigh the risks. The conclusion, therefore, is that the fund only uses liquid, exchange-traded equities that are semi-monopolistic, price inelastic, they have strong balance sheets, high dividend yields, which we class between 4 and 6%. The fund doesn't use any leverage, completely transparent and easy to understand. It is daily traded. We have dollar, euro and sterling share classes. And the premise is that if you can add those characteristics of those type of stocks, being your Sydney Airport, your Telstra in Australia, your Deutsche Telekom, your AstraZeneca, to the premium income you are able to generate from writing a covered call, you get a very attractive strategy for investors today as a daily traded fund. If you'd like further information, by all means, please allow one of our representatives to come and see you, or one of the investment managers can discuss the fund with you in more detail. Thank you very much.